The two primary taxes that help pay for half of this bill are an increase in the Medicare tax and then also an increase in unearned income. So on the slide above, it was one of those things, how do you illustrate this so people can hopefully take something away from it? The green line at the top of the slide indicates earned income. And so if you think about what earned income is wages. Earned income is income that flows through from a partnership that you actively participate in, because that's subject to self-employment tax. It's also working interests in oil and gas wells are what are known as earned income. Those are probably the three most common types of earned income. But the green line at the top represents what that income is, and we have a couple of breaks intentionally because we show, and we're estimating out there in 2013 what this, it's called the OASDI maximum base. It's sometimes called your FICA limit. But you have both an employer and an employee paying into FICA or Social Security, and that caps out. Estimated is going to be at $118,000. That's no different than we currently have. That's nothing new. Yellow lines are nothing new. That currently happens. The blue lines are Medicare tax, and the employee pays half and the employer pays half, and that's on all earned income. And it's unlimited. It's not a very large tax, 1.45% paid by each party, up through an unlimited amount of income. The red line is the new tax. So we have a 0.9% increase, but only for people who have earned income greater than $250,000. And again, it's hard to illustrate this. The $250,000 number is the amount a married filing joint tax payer or payers have. So you could have a situation where husband and wife filed jointly, they each make $150,000, and you think, well, we're not subject to this. Neither of us makes more than $250,000, but that's not true. They actually would be subject to it because their total earned income is $300,000. So $50,000 of that income is going to be subject to another 0.9% tax. It's interesting, it's on the employee's portion, not the employer portion. So that's money that the employee will pay rather than the employer. Another tax is a little bit larger tax, is a 3.8% tax on unearned income. This tax applies to individuals, trusts, and estates. It does not apply to C corporations, and I don't want to make everybody in the room a tax professional. Then what would I do? But many of you might be thinking, well, I have an S corporation or I have an LLC. How does that interact with this law? Well, income from an S corporation or an LLC flows through to an individual taxpayer, the partner or the member or the shareholder, depending on what type of entity we're talking about. So realize that this tax could impact you. The only type of entity it does not is a C corporation, and a C corporation is a corporation that pays tax at the corporate level, and then when it distributes income to the owners, they pay tax again. So it doesn't apply to them, it applies to us. Same limits here in terms of if a taxpayer's modified adjusted gross income is over $250,000 for married filing joint, over $200,000 if the person is single, over $125,000 if they're married filing separately, and only over $11,000 if we're talking about a trust or an estate. So probably many of you didn't even know you had multiple options of how to file your tax return. That's okay. The point is, it's only going to impact over $250,000 married filing joint. That was a campaign platform by many people during the last election that they weren't going to raise taxes on people who made less than $250,000. So that's the history of how that number came to be. Unearned income, I refer to as unearned income. You may also hear this referred to as passive income, or you may hear it referred to as investment income. I intentionally avoid those terms because those terms do have technical definitions in the tax world. We know what investment income is, and it's different than what we're talking about here. We know what passive income is, and it's different than what we're talking about here. So this term unearned income has kind of gained popularity, but unearned income includes things such as interest, dividends, capital gains, rents, unless you're in the active trade or business of rental. My brother-in-law, for example, that's what he does. And so to him, rental income is not unearned. You have royalties, could be from oil and gas, could be from many other types of things also. And then you have passive income from partnerships and S corporations. So this is going to become, if you have an LLC or a partnership or an S corporation that you do not actively participate in, okay? You're an investor in it and that income flows through to you, that income is going to be subject to this additional tax, 3.8% tax. Noted a few things here of what it does not include. Municipal bond interest, which is tax exempt. Interest from partnerships and S corporations where the taxpayer does actively participate. So again, the other day, the person I was having a conversation with works with a lot of our clients that are banks and bank owners, and so it's not uncommon for them to have a certain number of those bank owners who are actively involved in the bank. You know, they're in management, and then they also have a number of owners who are not involved at all. They're family members of the owners, or so they got their interest some other way. That second category of people, they're going to be subject to this 3.8% tax. The next few slides, it'll work a lot better on the screen than it will on your paper, just the way it'll come up. But you can see our current tax brackets. We have a 10% bracket, a 15, a 25, a 28, a 33, and a 35. So as income goes up, you're taxed at a higher tax bracket. That's 2010. I've shown married filing joint because I could only show one at a time, so that's the one I chose to show. On the next slide, you see some dark gray additions that come in. Okay, these dark gray additions have nothing to do with health care reform whatsoever. These were already tax increases that were already set to come in 2010. In 2001, when tax legislation was passed back then, it was an economic stimulus package actually, it wasn't tax reform, it was just economic stimulus package. There was a 10-year period on many tax laws. Two of the biggest ones were the tax brackets and then also the estate tax. And so that's why if you've read the paper or read online much, you'll see a lot of articles about the estate tax and how we don't have an estate tax right now. That comes back next year, as does the gray tax brackets. Those are set to increase anyway. In 2013, we then add on these red brackets that for taxpayers greater than $250,000, there's going to be an additional 3.8% tax. So nothing else changing. We're going to see people in the highest tax bracket go from a 35 up to a potentially a 43.4% tax bracket. Again, I don't want to make all of you tax professionals in just a few minutes here, but there's another source of income I don't have a slide for, but it's dividend income. For taxpayers who receive a lot of their income from dividend income, right now that's currently taxed at 15%. Okay? In 2010, that's taxed at 15%. That number is going to go potentially to 43.4% in the next 4 years. And so what we've all talked about and what I would encourage you all to talk about with your tax attorneys and tax consultants, tax planners, is how do you plan for, one, how do you plan for this, and two, how do you minimize the impact of this? You know, there are some strategies you can do. You very seldom avoid taxes. What you try and do is minimize or delay. You know, those are the two primary advantages. Well, let me rephrase that. There's not a whole lot legally you can do. It's called evasion. But the point is you try to minimize or delay, and you do have time to plan for that. This is 2013. We're in 2010 right now. You've got a good 2 to 3 years to manage this, and so that it impacts you as least as possible. So.